Okay, let's unpack this. Vietnam has been, well, quite the economic darling, hasn't it?
Absolutely.
We're talking impressive growth, strong exports, managed inflation, attracting foreign investment, the whole package.
It really looks that way on the surface.
But our sources today, we've got this stack of reports on Vietnam's debt dynamics, and they reveal a fascinating counter-narrative, a hidden vulnerability maybe, something that could surprise you.
Yeah, while that boom is certainly real, the striking contrast lies in what our sources uncover about Vietnam's, let's say, financial stability.
Mm.
We're going to dive deep into its public, private, and external debt, and crucially, the health of its banking sector, especially regarding these non-performing loans, or NPLs.
Right, NPLs. Okay, so our mission here is to extract the vital insights from these reports so you, listening, walk away well-informed about this nuanced situation and maybe draw some critical historical parallels, too.
Exactly. Context is key.
So with this potential vulnerability in mind, let's first look at what gives Vietnam some, resilience. Our sources do point to strong fiscal foundations.
They do. That's important.
Their public debt is commendably low. It's estimated at about, 34.7% of GDP for 2024, well below their own 60% ceiling.
Very manageable.
Plus, they've got robust foreign reserves, hit $83.3 billion back in July 2024. That provides a significant buffer, right? Like 2.5 times their short-term external debt.
That's a lot of fiscal space, definitely.
Yeah.
Is a strong foundation, gives them a crucial cushion.
I sense a putt coming.
Well, yeah. Our sources quickly pivot to what they see as the primary emerging concern, this rapid expansion of private debt. This is kind of the bombshell, really. Yeah. Total private debt that includes all the loans, debt securities, everything reached an astonishing 130% of GDP by May 2025.
130%. Wow.
And this figure is identified in the reports as the highest in the entire ASEAN region. That signals a massive pile of leverage building up, largely outside direct government control.
And here's where it gets, even more concerning, perhaps. Our sources highlight a worrying trend in the banking system's NPL ratio.
Yes, the non-performing loans. Money loaned out that isn't being repaid on time.
Right. It jumped from a pretty low 1.5% back in December 2021 up to 4.8% by March 2024. That's nearly its all-time high, isn't it?
Very close. The peak was 4.9% in September 2023, so it's hovering right near that stressful level.
And the concentration seems stark, like 18.5% of total outstanding loans are just in the real estate market.
A known risk area.
And consumer loans saw an NPL rate of 18% in early 2024. That's huge.
It is. And this feeds into what the reports call a monetary imbalance. Basically, the M2 money supply, that's the broad measure of money sloshing around the economy.
Right.
It's growing at 13-15% annually. Which sounds good, maybe, but it's far outpacing real GDP growth, which is more like 10-11%.
So where's the extra money going?
Well, the report suggests much of that capital is pouring into real estate and the stock market, potential bubbles forming.
Okay, this kind of rapid credit expansion, the NPL buildup, it does sound eerily familiar.
It connects directly to historical precedents, unfortunately. If you think back to the Asian financial crisis, 97-98.
Yeah, Thailand, Indonesia.
Exactly. Surging NPLs were a major contributor to those deep recessions. So based on these historical lessons, our sources actually define some critical NPL thresholds for Vietnam.
Like warning levels.
Precisely.
Yeah.
A moderate stress scenario would see NPLs maybe hitting 7-8%. That could lead to a significant slowdown, a credit crunch.
Okay. Bad, but maybe manageable.
But then there's severe stress or even a collapse scenario.
Yeah.
That could happen if NPLs hit 10-15% or even higher.
And that means?
That risks a systemic banking crisis, capital flight, a substantial GDP contraction. It's a sobering reminder, that even booming economies aren't immune to these classic financial cycles.
So, okay, with that rather concerning backdrop, what about the mitigating factors? Where do our sources say Vietnam has some resilience beyond just that public debt cushion we mentioned?
Absolutely.
Yeah.
Because there are mitigating factors. That low public debt is just one part of a broader policy toolkit they're using.
Right.
The State Bank of Vietnam, the SBV, they're proactively tightening financial rules. For instance, they're implementing international Basel standards.
The banking regulations.
Yeah, and introducing things like the new Circular 1420225-TT-NHNN. These measures basically force banks to hold more capital, which acts as a crucial buffer against losses from bad loans.
Okay, strengthening the bank's defenses.
Exactly. And you also have the Vietnam Asset Management Company, the VAMC. It's stepping up its efforts to actually resolve these bad loans to get them off the bank's books.
So they are actively trying to manage this.
Oh, definitely. The ongoing challenge, and it's a key policy focus, remains carefully managing that overall credit growth, trying to prevent those asset bubbles from forming or getting bigger in the first place.
So wrapping this up, what's the big takeaway for you here? Vietnam's economic story is, well, incredibly dynamic, powerful engine. But this deep dive clearly shows the tightrope they're walking. That strong growth seems balanced against this critical need to, keep a very close eye on their private debt and that NPL situation.
Absolutely. This isn't just about cheering for high growth numbers. It's about understanding the subtle, sometimes hidden forces shaping an economy, the underlying health, really, of its financial system.
Right.
For true insight, you really have to look beyond the headlines. Critical thinking is essential, especially with so much information floating around.
So for you, the listener, here's maybe a final thought to mull over. How does a country actually balance that rapid, ambitious growth with maintaining financial prudence, especially when so much capital is flowing into just certain sectors like real estate?
It's the classic challenge.
What are the long-term implications if that balance isn't managed really carefully? Something to think about until our next deep dive.